Hello, everyone. Thank you so much for joining us today. My name is Sarah Campbell. I'm USDA's National Beginning Farmer and Rancher Coordinator. So we handle all things new farmers at USDA, me and my team. And we also run our taxpayer education initiative for USDA, which is why we are coming to you today with Ruby Ward from Utah State University and Adam Kandrovich from Clemson. Today, they're going to be talking about tax considerations for producers under financial distress who are selling assets. Just a few housekeeping notes as we get started. If you've got questions, please put them in the Q&A. This webinar is being recorded, and the materials and the presentation will be available online. It usually just takes us a week or two to caption the video and get all the materials out of PDF and polish and package, and then it'll be posted and linked on farmers.gov/taxes, as well as our farmers.gov ag tax playlist on our YouTube channel. So there's actually a whole repository of really great resources on both worldtax.org and farmers.gov/taxes. So without further ado, I'm going to hand it over.
Thank you, Sarah. So we are just going to get into it. As Sarah mentioned, ruraltax.org is where we keep a repository of information, and then that's linked back to farmers.gov/taxes. And this is a website hosted here at Utah State University, but the material is developed by the National Farm Income Tax Extension Committee, and it has a lot of different information on agriculture, farm tax issues, timber tax, and these are just a few of the topics that are listed there. And at the end of this webinar, we'll show you more about some of the sources that are available there in a broad sense, but also that correspond with the materials we're presenting today. And we're doing this under a project supported by the U.S. Department of Agriculture. And so, as you can see here, the opinions, findings, and conclusions recommendations do not necessarily reflect the views of the USDA, and you can see the rest of that information there. So today we are going to cover cash flow and taxes because I think this will just really kind of set the stage for why we're talking about these issues related to farm financial stress. And then we're going to talk about potential tax consequences arising both from previous year decisions and also when you're selling assets that you might face some of those, then get into some tax management options. And then, as I already said, we'll talk about some of the resources that are available because we're going to just touch on a lot of topics here today. And so we're not going to go into them in depth, but there's articles, webinar recordings, and other information that you can use. And so we'll go into what those are a little bit later. But to start off with, we wanted to also just provide a little bit more background. None of what is found in this presentation today should be considered a form of legal advice. It's for educational purposes only, because it really gives you a kind of a broad overview and some issues that you should be aware of in your own planning and stuff. But for legal and tax advice, please, we highly recommend that you work with a professional tax preparer for your unique situation. And because everything that we're discussing is really general, and in the tax code, there's a lot of nuances that really can affect individual situations and their facts and circumstances. And there might be some IRS law changes and stuff. So just be aware of that. But with that, we'll get into the actual meat of the presentation. So to start off with, we wanted to discuss this link between cash flow and taxes, because I think that this is a lot of the motivation for this presentation today. Financial distress can come from both things that are more current. We've got a lot of turbulence, disasters. There's a lot of drought across the US now. There's price issues, input cost issues. I know fertilizer is up quite a bit, fuel costs are up. And so we have all of those. And as you think about it, a lot of times when we're talking about financial distress, we may be talking about financial analysis and kind of what does the picture look like. And then some of those external factors that such as the turbulence, the prices, input cost prices, yields, all of that, the disasters, and kind of how that affects cash flow. But what we're really talking about today is there might be some unexpected tax liabilities that either that are already arising from previous decisions or that could be part of some of the strategies you're putting in place because of the situation as you're doing financial analysis, considering things. And so we want to just show kind of how to really kind of consider the taxes and the link and the potential impact on your cash flow as you're going through and kind of analyzing individual situations. And did you have anything to add here, Adam?
No, you said that very well and succinctly. Basic idea is a lot of times individuals begin to confuse cash flow with other issues. But we always forget about those taxes. And so there's nothing I could add that you haven't already stated.
Yeah, and so we're not going to get into, financial distress as far as like current things in general that you can do or long-term, planning and other things that might be affecting that. We're just really wanting to just talk about this green circle here today and how that might affect the cash flow and give you a little bit more understanding of that and some other considerations. So the potential tax consequences, and when we say tax consequences, what we really mean is liability or potential taxes that you will have to pay and owe in the, next year or so. And so these can really kind of come in from tax decisions from previous years, as we already mentioned a little bit, and they may increase the tax burden for the current taxable year. And so for 2026, you could be looking ahead to the rest of the growing season and stuff and what might happen, but there may be some deferred taxes on current assets because of previous year's decisions. There may be some things like accelerated depreciation. So these are just examples of where you could have more income on your tax return than you're expecting or less expenses, deductibles that you're expecting. And then another one, a big category of potential tax consequences is if you're looking at selling assets such as livestock, your cattle, equipment, land, and if they have a low tax basis, meaning that, for example, raised livestock might have already been completely expensed because we just expense the cost of raising them. So they don't have a tax basis, which means when you sell them, it's 100% income. And so could have some capital gains tax from this. Also, there's some depreciation recapture. And we're not going to get into really dive deep into tax code here. We're just going to show you kind of and discuss both of these main points, the previous years and the selling assets, in kind of broad terms to just show you what those potential tax liabilities might look like and why it's important to keep them in mind. So, um, so first of all, talking about previous tax decisions. And in order to really kind of talk about why some of this stuff is happening, we have to talk about cash basis. In accounting, both for your accounting records and also for your tax return for farm purposes, you have the option of either doing accrual, which matches the year's production with the year's expenses, or you can do it under cash basis. And for most farm returns, or most tax returns with a farming operation included, the farm, your Schedule F from your farm profit and loss is done using cash basis, which means that income is recognized in the year that it's sold and expenses are recognized in the year that they're purchased. And you can't hold checks. So if you get a check, at the end of December, you can't hold on to it until January to recognize it in the following year. You know what I mean? So but that's cash basis. When the cash comes in is when we recognize the income. When the cash goes out is when we recognize the expenses in whatever year that is. So you could have income from previous years that could show up on your current tax year because this is what we've referred to as deferred tax. So tax on income that was deferred from a previous year. For example, your stored crops. And often it's omitted from most balance sheets because you deferred it from a previous year, but if you're going to continue a pattern of deferring it into the future, then a lot of times when they're looking at like operating loan decisions and other stuff, they might not be including that on your financial statements. And so sometimes it just kind of gets pushed to the background and kind of forgotten about. But then in years where you have financial distress, a lot of times that's when it really can kind of rear its head and really kind of catch up with you. So it's good to be prepared for that. And then other things that could arise is you've already taken those deductions because you paid the cash in previous years. And so, and with depreciation, especially we have really generous options for depreciation. So there's some things for when you buy a depreciable asset like certain single-use building or structures and equipment. You may write off the whole amount that you purchased it for in the year that you purchased it, but you may still have a loan on it that you're paying off. But you're expecting maybe to have some expenses for depreciation, but those already happened in the past, and so we no longer have those deductions to take in the current years. And so we'll dive a little bit deeper into this and show you kind of some of the effects of these decisions. So income from previous years. For example, if you harvested grain in 2025, and if you sold the grain, sold it in 2025, the year that you harvested it, it would be show up on the 2025 tax return as farm income. Um, or if you stored it and then sold it in 2026, it's going to show up on the 2026 tax return. So same farm, same production, but depending on how, when you marketed that grain versus when it was grown, when you marketed it is really when it shows up on that tax return. So it could really have completely different tax liability in those different years based upon how you're doing the tax treatment. In a year with financial distress, there can be taxable income from those commodities sold early in the year. So right now we're looking at 2026, and like I said, for a large portion of the country, we're seeing a lot of drought situations, and we're seeing some of the other issues with the input prices and some other things. And so sometimes we have it in our mind that, oh, well, our yields are not going to be that high. We're going to have really high input costs this year. So we probably won't have a lot of tax liability. But you may already have some tax liability for stuff that happened early in 2026 because of stored commodities that you sold in 2026, but they were really produced in earlier years. And so this is just to be aware of this and see what can happen. And right now, it probably still kind of sounds pretty nebulous because we haven't got into some examples and stuff. So let's do that now. So here's our example. A married couple filing jointly, both under 65 years old. Their only income is the farm income, and their net farm income subject to taxes is their farm income minus their farm expenses. So they had $200,000 of farm income. There was $31,603 of expenses. And so their net farm income subject to taxes was $168,397 in this example. And then to get to their taxable income is that net farm income subject to taxes minus the standard deduction, minus a deduction for your 199A, and minus a deduction for your self-employment tax. And so when we do all those deductions here, it's going to bring that 168,397 of net farm income down to $100,000 of taxable income. And then for our federal taxable income, as you can see on this chart here, for a married couple filing jointly in 2026, that first $24,800 is taxed at a rate of 10%. And then anything between 24,000 and $100,800 is taxed at 12%. And then if you have more income, then it would just keep filling up those buckets, you know what I mean? And then you get taxed at a higher and higher percent. But in this case, that first 24,800 is taxed at 10%. So that would be $2,480 in federal income tax that would be owed. Plus the difference between the remainder of the 100,000 of taxable income minus the 24,800 that's already been taxed at 10%, that difference would be taxed at 12%, which would give us another $9,024. And so the total federal income tax on that would be 11,504. So one thing that I also, and so that's just kind of the magnitude of it. So think about if you happen to have had an extra $100,000 or, you know what I mean, of grain that you sold in 2026 above everything else, you know what I mean, then that could have increased if your other stuff's already taken up your standard deduction, your 190, all those types of things. You could have, you know what I mean, some tax liability. Every situation is uniquely different. And so this magnitude might not be the same you might have more expenses. There might be some other deductions that you have. There's a lot of different stuff that could be in the tax code, but this just gives you a general idea of what the tax liability could be. One thing to think of too is that this 10% rate and this 12% rate is a lot lower than 22%. So it could be if you've been deferring income and have a big deferred income, an amount that's a tax liability that's going to be paid at some point in the future. It might be if you have the financial distress allows you to actually use up some of these lower brackets in these low income years. And so I just kind of took a tangent that Adam wasn't aware of, but do you have anything else to add there, Adam?
No, that's good. And something as you were talking, I just realized too. So we actually ran these numbers through tax estimators, tools, and other things. And I actually realized we're showing the 2026 rates, but when we actually ran it with the estimates, we were still using the limitations from 2025. But we did off to the side run numbers by hand for us to kind of double check. And they are correct. The point being is that you need to understand that every situation is unique. There's going to be differences. And the idea is when we begin to go through in any normal farm situation, things are not black and white. We have things that are falling over that will affect us today, that based on decisions that were made sometimes years ago from a tax management standpoint, like Ruby has stated. And so um, just know that there will be a couple of things that may look off if you try to do those equations by hand on a napkin right next to your computer. But trust me, they are correct. It's just because we are also rounding for these particular, or we may be discussing things, and when you see an image on here, it may be somewhat rounded based on what we're putting out there. But when you take a look at the calculations on the back side, it's not fully equal to, let's say, when we get to our self-employment tax, for example, things begin to get wonky.
Yeah, so this was just a simplified example, and we're trying to not go too deep into all the details to get you lost in the weeds out without missing the general concept. And that's kind of what Adam was talking about is so we are kind of having ballpark type numbers with, some of these things that gives us in the realm of really close, but not exactly because there's some nuances that we're not including here on the screen in the examples. So the other tax that we sometimes forget about is the self-employment tax. And that's because if you're an employee from someone and you have a job and they're withholding some tax and they're withholding amounts for, the employee portion of the federal or the self-employment tax, or sorry, not the self-employment tax. It's their withholding part of the like FICA and Medicare, you know what I mean, those types of things. And then your employer matches it and then sends the whole amount to the federal government, which is about 15.3% of everything you make. As a self-employed person, you get to pay the employee portion and the employer portion, and that's called self-employment tax because you're self-employed. So that's where the 15.3% comes in. And so anything under 184,500 would get taxed at that rate, basically. And then a portion of that would be deductible as against your income tax. So your total federal tax would be, so on this, we had 156,500 and just coming back up, that's subject to the self-employment tax of that because it's the net farm taxable income. So this 168,000, but we get a little bit of deduction for, some of these things. So when we get down to the adjusted gross income from that, from all of our sources, basically it comes back down to about 156,500. And this is where Adam says, we're not going to trace through every minute detail to try to tell you exactly how you get down to there. Just know the concept. And you're going to be close if you just think of the 15.3%, but no, it's actually a little bit lower than that because of some of the interactions. And so this comes out to $23,794, so almost $24,000. And so our total federal income tax with the income tax or federal tax, the income tax plus the self-employment tax comes out to 35,622. So as you can see in this situation, the self-employment tax is by far, it's about two-thirds of that. So when you're only thinking about income tax and not including the self-employment tax too, you could be wildly understating what your potential tax liability could be. And then if we think about potentially adding on a state income tax, every state is different, so we're not going to get into the rules of individual states. We just kind of stick with the federal so we can be kind of consistent for situations. But let's just say that's about 5%. And so 5% on that $100,000 of taxable income would be another $5,000. And so our total taxes owed would be 40,622 when we consider the self-employment, the income, and the state income tax. So on $100,000 of taxable income, 40% of that in this situation with these numbers is a tax liability. And that's why we really kind of strongly believe and wanted to do this webinar is to say these are things that we want you to be aware of and potentially the magnitude of the tax liability that you could be facing, even in a financial distress kind of where you're thinking it's a low income environment, but because of some of these other interactions and things that had happened in previous years, you may have more tax liability than you're aware of. And but again, every situation is different. So so those were looking at kind of the things from previous years and how they might affect, your potential tax liability from your income tax. Now we want to look at if you're selling some assets, because if it's a financial distress situation, then we might be thinking of potentially, or because of some of the drought conditions, right? We might want to decrease our herd size, in a year like this. Look at selling some of our equipment or some of the other assets to potentially inject some cash flow into the operation to manage our liabilities for the current year, right? And so if you're selling non-current assets, um, you could have capital gains and then there could be some depreciation recapture. But the rates for 2026 for long-term capital gains rates for married filing jointly, you can see that they're a bit different than what we saw with the income tax rates because capital gains allows us to be taxed with some special rules different from the ordinary income tax rules. And so up to the first 98,900, there's a 0% rate. And I want to say that with a little bit of a caveat because some of your other things could be affecting that, but just know that it exists. And then up to that 98, 900,000 up to 613,000, that's at 15%. And then we basically cap out at 20%. So the cap out is a lot lower than what we capped out. I'm just going to backtrack. So as you see those rates, see, we're up in this vicinity for everything, where we're capping out. And so it's a lot different for the capital gains rates versus that, but you still may have some really significant tax liability. And
It,
so go ahead, Adam.
yeah, I was going to say that, one, going through this example, it's important to understand what we are showing you here is making the assumption this is all that I am selling for this year to come up with this particular tax liability. We don't have what we had in the previous slide. We'll show you how that interaction works here in a
Yeah,
moment.
so yep, we've got it here. So let's
So
get into the example. So selling 100 raised cows at $2,500 each, and there's no tax basis because these are raised cows. Everything that went into basically the cost of raising them, the feed, the labor, the facilities, all of that actually got expensed as farm expenses, in all the years that the cows were alive. So when you go to sell them, 100% of that is taxable. And so, because there's no expenses, no depreciation, no tax basis or sorry, not depreciation, tax basis that we can take against it. So, if we assume that that's the only activity we had on a year's tax return, which is a wild assumption, but it gives us the ability to just kind of look at some numbers in a more simplistic way, then though we'd have the $250,000 coming in from selling the cows, we'd be able to subtract off that 31,500 standard deduction, and that would leave us with a taxable income of 218,500. And then if we look at the tax on that, it's going to be 17,940. So 0% is going to be this um, times the So, uh, so you're going to have 0% on this first 98.9. I think I put this number wrong, the 22,665. It should be the 98.9. But our calculations for the total tax are correct. So 218,000 minus the 98,900,000 that we had 0% on. This 15% we're going to have to pay on this difference because that's the amount that's in this bracket. Because the first 98,900 we don't pay anything on. And so when we do that, it's going to be 17,940 that we would have with those cows. If we take that previous example that we had that 168,397 of net farm income, and then on top of that, we add on selling these cows for 250,000. When we work out the numbers with all the interactions and everything else, that it's at 37,500 because um, this 168,000 of net farm income and that taxable income, that wiped out this bracket for us because this capital gain is on top of our ordinary income. And so basically everything's going to be moving up into this bracket, and we're going to have to pay 15% on the full amount that we had of those capital gains.
Ruby, I think I just need to make a quick correction here. I think that 37.5 is the tax on only the cap
That's
gains.
right. Yep.
And if we were to, just as Ruby described, if we were to then take these cap gains on top of the previous example,
Hmm.
the total tax, it's not just like I can take these two and add them. It doesn't work that way. There's a symbiotic relationship between our ordinary earned income, as we were talking about in the previous example, and the cap gains, where here, as Ruby stated, the $98,900, first, you have to utilize all other income that's ordinary income to fill that up. And if that gets topped off, and we said we've got $100,000 of taxable income, we have already used up everything up to that 98.9, even though it wasn't used for a capital gain event, which now leaves open this next $250,000 falls into the next tax bracket. And so if we were to actually do the previous slide for selling the ordinary income or selling the commodities for the ordinary income, and then we sell these as cap gains, our actual tax is going to be just over $73,000 when you consider self-employment tax, the ordinary income, and the capital gain on it. And so our capital gain, just in that type of example, would actually increase, would end up being the 37.5, along with now having to add the ordinary income tax
Yeah.
plus the self-employment tax, which then gets us to that 73.
So again, the kind of the point of bringing this up is not so that you can calculate the exact tax that you owe. And it's not so that you can become a tax wizard. The point of bringing these up, and so don't get too lost, you know what I mean, all the calculations. We wanted to show them so you had an idea of, in general, how your tax calculations are working. But this is why it might be good if you're really under financial distress and have some cash flow issues and some other things, as you're looking at strategies, work with a tax professional that can both help you set out these strategies, but then also consider the tax ramifications so you truly know what you're really gonna, how you're gonna affect your cash flow. Because if you're leaving out like that $70,000 of tax, tax liability, and this is really kind of a tight cash flow situation, then that can really throw off all of those strategies that you're putting in place. Also, you don't have to wait until you're ready to file your tax return to kind of think about these things. You could be looking at them over the summer if you have some indication what your prices are, what your yields might be, what your input costs are. When you have that information, you can already start kind of bringing that into the situation. And so think about how that might affect your tax liability. And it's just one more piece to consider. So we have a tax estimator tool. Adam actually put it together on the ruraltax.org website. and it allows you to estimate tax liability under different scenarios. So you can kind of do a base scenario that you can look at with kind of your normal situation. And then in the next column, you can start adding and changing things around and stuff. So you can see the effects of, well, if we sell these extra cows, what happens there? If we, do some of this, if this goes down, if this goes up, well, what if I have this? And so it just allows you time to plan for the tax obligations. Right now, it is the 2025 tax year is the version of the tax estimator tool that's available, but it's going to get you really close to 2026. We can't put 2026 together until the IRS comes out with more, because we don't really know everything about how 2026 is going to be treated until we get, you know what I mean, more towards the end of 2026 when there's more IRS guidance that comes out each year. And so we will be publishing a 2026 version, but it'll come out probably in the spring of 2026. So use the
I should
20,
have that ready to go. Usually I release that 26 August or September.
okay.
We should be have it. It may, like Ruby said, though, it still may miss a few things if it had not been up, if the IRS has not updated some of their
Yeah,
limitations.
and then usually around January, I think you usually make an update
I
if
do.
needed once we know what's going on. So so this is exists. What we put together was a landing page on financial distress under the main website for rural tax. And so this QR code takes you there. And at the end of this, we'll show you some of the other information that's on that. But I just wanted to bring up the tax estimator tool because I think it really is the best tool for the stuff that we've already talked about, kind of calculating those unexpected tax liabilities. Where are you at? And kind of including it with part of your planning options. And again, it's probably going to be valuable to work with a tax professional, work with a farm financial management advisor, and just bring up some of these things. Um, and so it's, and I think that we'll go on with the rest, and onto some of those next topics, and then we might circle back to some of this depending on how much time we have. So we will move on to the next topic. And then a basic part. So now we're going to get into leaving kind of unexpected tax liabilities or tax liabilities and how they affect cash flow. And now we're going to talk about tax management. And tax management is a basic part of any business management practice. It's not how you get out of paying taxes. It's really about, because if you are trying to just pay zero tax possible in one year, it doesn't make it just suddenly disappear. It either means that you had paid way too much for the expenses of running your business, so you had zero income, or it means you've probably done things that are pushing a larger tax liability into a future period. And so this is really tax management is using available internal revenue code to get the most amount of income through the tax system at the smallest rate possible. So we want to kind of maximize our after-tax profits. And that requires pre-planning, and it also requires records and having a good set of records, good accounting, bookkeeping, because we need those numbers in order to really be able to look at the situations. And then it also it requires an understanding that accounting, the record keeping, the tax management, they all have that symbiotic relationship. And as we've already kind of alluded to in some of the previous examples, there's a lot of things that are going on within that tax return. And so changing one thing, even it doesn't just change only that on your tax return. A lot of times because of the interrelated and nuances of the situation, it can change multiple different things and have. But so this is what tax management is. But basically it's when you can do some really good planning because you have good records, and it's really kind of planning on how to use the options available in the Internal Revenue Code to make your tax liability to give you the most money after your tax liability as you can have over several years. So here are some of the tax management options that are available for farm income. There's some weather-related sales of livestock options. If these are provisions to allow, and I'm just giving you some really kind of brief things of this, but we have information on all of these and we'll show you that too. So it'll go into detail. This is just kind of your overview webinar. So weather-related sales of livestock, provisions that allow for sales of livestock because of weather situations to be able to not recognize the income from those sales if the animals are replaced during a certain period of time. And it goes into a lot more restrictions and nuances and it has layers and options for your calves, options for cows, your breeding livestock and stuff, and some different things. So it's a little more complicated and has more provisions than what I'm bringing up. Most of it requires, if not all the provisions, require a disaster declaration to allow for that. And um, then there's another depreciation. So depreciation is how we expense equipment, fencing, things like that over multiple different years. And so there's options for when we take those depreciable expenses because options can accelerate it and put a much larger amount in the year it's purchased or the first year of service. There's also other options that kind of push that out over multiple years in more of an even format and stuff. So there's just some options with depreciation. Prepays is when we pay for supplies and other expenses during one year that will be used in a future year. So um, if I if you kind of look at your situation in November, December-ish, and you see, hey, this might be a higher tax year, then you might prepay some of your expenses, your fuel, your fertilizer, and then that can have more deductions in that taxable year, but it's going to cause you to have less deductions in a future tax year because you don't get to take those. Prepays do not allow you to just increase your deductions. Is what it is it's just moving deductions from one year into a previous year because you're prepaying for it. There are some restrictions on that. Sometimes prepays are needed not because of tax purposes, but because of locking in price agreements on some of your inputs, costs, also availability of your inputs. Sometimes there's been years where you had to kind of pre-contract for certain fertilizer, seed, and other types of things in order to have it available for when you needed it for planting purposes in the following spring. So there could be both management decisions that you're making why that it makes sense to that you need to prepay and lock in those contracts. It could also be that you're doing it for tax purposes too. And so there's probably a combination of things going on. And like I said, there's some limitations on that, but that's a common tax management strategy. Income deferment, for some individuals, they may be able to defer some of the income into the next years, depending on the type of income. Crop insurance payments will allow a portion to be deferred, depending on the farm's historical norm and some of the timings of their crop and stuff. So it's just another thing that there's provisions for all of these nuances depending on your situation, but it's just kind of a broad overview. And then other things, selling assets for cash flow, like we've already kind of talked about, there's a need to consider the potential tax liability with those and kind of knowing what those the tax consequences of that will be so that you can not just look at what can I sell it for, but then also what might the tax liability be related to that. And then when you're into tax management, the timing matters. There's some of the tax management practices that should be done before the end of the tax year. So if we're looking at them for 2026, there's things that you would need to do before the end of December in 2026. They're going to affect the tax liability for the 2026 tax year. And then there's other options that you do after the end of the tax year as you're preparing your tax return. There's some other options and nuances within the Internal Revenue Code that you can use. So, but timing matters. So in an ideal world, before the year end, you would be meeting with a tax professional. You'd be estimating what your total year's income and expenses and things are going to be. So you kind of rough those plans out and then just kind of figure out what your strategy is going through the end of the year. And also, like I said, there might be some farm management decisions and production decisions that affect some of these things too that need to be done in November, December that could also affect the tax liability. So you want to just plan for some of those and know the realities of your individual situation. Any thoughts, Adam? All right.
You got it.
Okay. So then here is where we're kind of circling back into kind of the take-home message that I would say if this is kind of the main thing, we kind of circled around to some different ground is that we know we have some external factors that can be causing financial distress, input prices, drought situations, prices, just commodity prices and things like that. And then we also know that every situation is looking at their financial analysis with their own situation, that there might be previous years, because the financial distress could be something that's been building up for multiple years for this individual operation, and then this is just compounding the effects of it. Or you might have an operation that this year is looking really rough, but actually because of previous years and things, they may be in a better situation to weather the distress of the current year, you know what I mean, going forward and stuff. So that's where, the external factors, the situation, the financial analysis of your, the individual operation. And then this is just saying that we've talked about today is the importance of bringing the tax liability and tax obligations into the conversation and making that a general part of what you're looking at as you're planning with the financial analysis, farm management decisions, those others, because your taxes can be a very significant liability and a significant cost for your overall operation. And especially in terms of financial distress, those can really be significant. So it's important to bring those in. We also kind of talked about this tax estimator tool, and it's available to estimate your tax liability. You can compare some of the options and kind of look at things. Having a base year or like last year's return available so you can kind of start with that and then kind of say, well, what was different during this year than last year? So it can kind of help you build out that situation. And then these are some tax management resources. We have a lot of them. So articles and webinars, and and the articles are meant to be really accessible. You can get, you don't have to have a lot of finance tax background to really get something out of the articles. They're also a way that you can, if one of these topics you want to work with your tax preparer, you can just send the article to them or pull it off, you know what I mean, to take it with you and say, hey, well, what about this? Or I wanted to just be aware of this. And they were meant to be to give a good overview of what some of the situations are and unique issues for farm tax returns, and in a way that you can have better conversations with your financial advisors, with your farm management specialists, with your tax preparers. And so it just allows you to kind of have some of that information and have better conversations about what decisions they're making on your behalf. And then, as we talked about, there's some provisions that might be kicking in because of some of the weather issues that we're relating now. So weather-related sales of livestock. There's also some other disaster type tax management. Some of these things have to be done before the year end, after the year end, and then we have the tax estimator tool. So this QR code goes to a landing page on ruraltax.org that is, we've set up to just have a collection of the materials on the website that are related, we feel are related to farm financial distress situations that might be useful. And it includes all of the stuff that we've talked about here. And then in addition to that, we have our general resources, and looks like I put the financial distress QR code in there instead of the real tax art QR code, but that's okay. It'll still get you to the same place. So the IRS publication 225, the Farmer's Tax Guide, it's on the irs.gov. And so just in the search box, just type in publication 225 and it should, or Farmer's Tax Guide, and it should bring it up either way. And I believe we also have a link from ruraltax.org. Ruraltax.org is our main website, and that has everything, but sometimes it can be intimidating to come in there. So that's why we create some of these landing pages that just have a collection of information related to a broad topic that is useful over a period of years for a lot of different people. And so these are those collection of topics. So new farmer is one of those, disaster, and then financial distress is another one that we have there, but there's various ones there. Tax management is also one. And so it's part of this, but we're linking back to other additional materials than just that. And then there's linked to the webinars that we do with farmers.gov, and farmers.gov/taxes is it also has a bevy of information there. The webinar recordings, this webinar recording will go there. We normally will link back on ruraltax.org to the recordings of those webinars, but they're hosted on farmers.gov/taxes. And so that's and it also, from there, you can link into a lot of the other resources on farmers.gov. So it's a great website and what you want to go to. So any thoughts, Adam? And then we'll want to also start taking some questions. So if anybody has some questions, start putting those in so that we can make sure we answer everybody's question.
I think there's a couple of real quick kind of take homes. One, when we end up in situations that we're presently in as a farming community across the country, and of course, there are different issues across the country, and there are some places that are doing fine. However, in many cases, we end up with farms or farm families going, all right, this is it. This is when I'm going to retire, trying to transition into retirement, and I'm going to sell the farm or I'm going to keep some of the land and sell a bunch of assets. And in their heads, we believe I'm going to sell this stuff and here's how much money I'm going to have. And we forget about that other component that there's going to be a liability when I sell that. What that liability is going to vary from farm to farm, farmer to farmer, based on those unique situations, right? So it's going to include potentially uh, depreciation recapture that may potentially have income tax, general income taxes, self-employment taxes, and these can be substantial. The other thing that we see occurring at this time is a lot of restructuring because of cash flow reasons. And we see others that are willing to roll the dice, um, such as putting up some new poultry houses or something along those lines. And Ruby early on talked about those single purpose buildings. And one of the things that we typically see is we cut our nose to spite our face. Where, all right, I can put my building up for X amount of dollars, and I'm going to Section 179 a large portion of it, and or bonus depreciate or rapidly depreciate that building so that I'm not paying on it for the entire 10-year lifespan if I'm using a specific depreciation technique. But I have a loan out for 15 or 20 years. And many times we end up seeing potentially cash flow issues that arise because I no longer have depreciation to help offset income. And that's what was needed to help keep the cash flow moving so that cash flow goes away or the cash flow begins to become a problem when the depreciation is lost from the purchase of that particular building. And I still now have to pay the debt payment. And so I may not have enough money to make the debt payment and to pay taxes. So that's just something to think about from a tax management perspective, as well as from do I need to sell assets to help make it over this hump?
Okay, and like I said, if you have any questions, oh, we do have a question. So looking to lease with the option to buy my bean harvester for $10,000 for 5 years. Renter owns after the last payment income 10,000 per year. I'm not sure, maybe you can, I'm gonna pull up this financial distress website landing page, Adam, and maybe I'll let you see if you can figure out what the question is within that.
So, looking to lease with options to buy my bean harvester. The It looks like $10,000 for 5 years, and then the renter will own it after the last payment, with income of $10,000 a year. So I'm not sure if you just want our thoughts on that. I will say, however, you do need to be careful because a lot of times we do talk, right, Ruby, that sometimes renting or leasing something can be a better accommodation for a particular farm because it costs less to rent and it's a direct expense versus having to make a particular purchase. And during certain dairy market times, we've seen this and we've had these types of discussions as it relates to choppers. Do you really need to own a chopper? But here you have left a couple of key points in here, which does raise a concern from an IRS perspective. And I'm going to let Ruby, after I make the statement, kind of jump in following me on this. Whenever you have a situation that is lease to own, in many cases, and I'm not saying all because I don't have all the facts and circumstances around this particular question, but in many cases around a rent to own situation, the IRS is not going to look at that as a rental or lease situation. They're going to look at it as a purchase situation, where really what you're doing is taking out a loan over this period of time. And so we have to be very, very careful with regards to that and how that is going to play within to the accounting and the tax liability that surrounds that. So that might be something that we need to talk about a little bit more in detail with whoever your tax professional is, and what you all feel comfortable with from an accounting standpoint, and how that is going to flow through with regards to, is that going to be considered a deductible cash expense to lower my profit, which therefore lowers my tax liability? Or is it truly going to be as it kind of looks like? It's really, I'm taking out a loan, it's a rent to own, which means it's a loan, and not a rental payment. Therefore, I have to pay that principal portion, right? And there should be a portion that is going to be considered interest, which is expendable as a deductible cash expense for tax purposes. But the rest of it, that payment is made after I've paid taxes on that money.
Yeah, and off the top of my head, I can't remember how they treat depreciation on those rent to own agreements, but that would be another thing to bring in. So I
Yes.
brought up this landing page that I said we put together for financial distress. And so here is what it looks like when you click on that QR code. And these boxes up here go to collections of information. So the farm, or and also just to the tool because it's so the farm income tax estimator tool that we referred to, that goes to that. The tax management information, the small farm tax guide is basically a book with multiple chapters in it, and so it allows you to just kind of go through if you want to learn more about kind of taxes and financial management and stuff and how they kind of interact. That just gives you overview without getting into a lot of specifics. And then disaster tax information, because that's where the weather-related sales of livestock, disaster losses, and some of those rules are. And then here's a few particular articles that we kind of called out during the presentation, so we put those in here. We also have links back to taxes for farmers and ranchers on USDA, so that's that USDA website that we talked about. And then the IRS.gov, so the IRS website, Regional Centers for Farm Stress Network, that may be helpful for some of this and just know that that exists. And then here's the drought monitor that shows kind of the overview of the drought situation for the United States. And so, and then you can also key in on different regions, but that's a valuable link also. So just kind of bringing up I'm just going to click on a few of these and then show you what they are. So here's the Farm Tax Estimator tool. You've got a recording of a webinar that'll guide you through kind of line by line how to use that. Here's the one for 2025. We also have the previous years that are archived. And then, like Adam said, in a few months, this fall sometime, we'll probably come out with the 2026 one, and then may have an update for that after the end of 2026 if there's some changes there. So going back, then the tax management information. We've got that one. So tax planning for farmers, managing after year end, before year end. And then you can kind of look down through here and we have basically all these webinars that kind of go into those topics. So succession planning, Adam kind of alluded to that. And then the after year end and before year end and some forestry information. So that we felt like would be really useful for you. And then the small farm tax guide. Like I said, it's more like a book with some different chapters, but it just kind of gives you overview of farm taxes, farm income, deductions, manage and timing of the deductions, character of income. So it's just, if you want something you're really into this and want something that'll just kind of let you over time just kind of work your way through some various topics that has some really good background foundational information. And then disaster tax information. So disaster losses, weather-related sales of livestock. So we talked about that, working with a tax professional, and then of insurance proceeds and involuntary conversions, and then basically the related webinars for all of those. So so if you want to just read an article, you want to listen to the webinar, this is really just a great place to kind of go back into these topics. And then let's see. And then so some of these other links we kind of talked about. If you want to get back to the home page up here, just click on Rural Tax Education, and that takes us to the main website, ruraltax.org. And it's hosted by Utah State University, so that's why it says extension.usu.edu up in here. But if you just type in ruraltax.org, that's easy to remember, and that takes you right to this webpage. And then the tax topics, so all of them, if you want to look at those articles or these collections of them, all of the webinars that we have, the farm estimator tool, you can get to it right from the top here. And so there's just a bevy of information here. And then in the related links, we also link back to the some of the other things that might be valuable to you, some of the individual tax programs of the various states, some of those other types of things. So with that, I am not sure. So was there another question that came in, it looks like? So, and if we don't see any
I
more
think
I
it
am,
questions,
I
was
am responding. Yeah, I'm responding to him in written form.
okay.
So if you
okay.
get from them, it makes a little bit more sense
Okay.
now of what's going on. And it's one of those things that we typically see one individual trying to help out another producer, given the
All
present
right.
situation. So,
Okay. Well, then I think that that's about it. Is there anything else that Sarah or Adam you want to
well, we've got 5 minutes. I can bring up the estimator tool if we have time. I know Sarah usually wants to finish off with something, and so
yeah, if you want to bring that in,
Yeah, go
yeah.
ahead, share your screen, and at least that way
okay.
folks can know where to find it too.
All right. So when you go ahead and you follow the link that Ruby had showed you on getting the estimator tool, and then you download it and you open it up, and this is what it's going to look like, except you're not going to have, I don't believe I've got any numbers in there. There's a tab here on the bottom that has some general instructions. I do strongly encourage everybody to run through the video that's there. That's JC and I working through this with an example, which will help explain a little bit on how it works. But using the examples here that we actually used in today's webinar, here on the left-hand side, these two columns, is where I've set up the first example where we had $200,000 in income and 31,000, just over 31,000 or just under 32,000 in expenses. And you will see in a couple of spots, you have to click on an arrow and choose yes or no to answer a question. If you see a red flag by any of these cells, that means that if I move my cursor over that cell, something's going to pop up and provide me with a few bits of information to help me figure out how to input information or what type of information needs to be placed in there. But if I go ahead and I simply just take a look at the two different examples, example number one over here, example number two over here in the option two columns, and you can see what our total tax liability is going to be between the two, 35 and 32, plus some. And so, that would say, oh, well, that's 67,000, 68,000 and some change. And you can see from here down, it is breaking down estimated ordinary income tax, what that might be. Over here, since it's all capital gain, that's all we're seeing is 32,775 in cap gain. Also remember right now, this year's estimator tool is using 25 limitations. I will come out in a couple of months. I do have a calculator already built that has some of the limitations that have been already put out there by the IRS. There are still some that remain, but that will be released here in a couple of months so that you'll be able to use that. But just to show you what would happen if I go ahead and say I'm going to sell that, I'm going to have those expenses and that ordinary income from the sale of commodities or produce, whatever it happens to be, but I'm also selling $250,000 in cows. And those cows are raised, so they're going to be long-term capital gains. And so this is where I would put that number, okay? And so now we come down here and you can quickly see how that has changed based on that particular decision just by adding that. We can see the 11,828 hasn't really changed. That's going to remain the same from an income tax standpoint. my long-term capital gains has increased because I lost out on that 0%, right? For the first $98,000 or thereabouts. And actually a little bit less using 25 numbers. And so that all got moved into our 15%. And then we can also see how much in SE tax or self employment tax we're going to be paying for Social Security, for Medicare. And then that totals that number, which gives us our total of $73,000 for this particular scenario. And so when you really think about this, though, I'm I am moving 450, about $420,000 through the tax system at a cost of that 73,000. And so you that's how you can take that 73, divide that by that total revenue that was coming in that is taxable, and you can come up with what your estimated effective tax rate actually is from there. And I think that might be one of the changes I'm going to make is throw that out there so that everybody can quickly see what their effective tax rate is for this coming August. So there's that. I will stop sharing my screen for that. And I'm not seeing any other quick questions coming through. And so, Sarah, I guess I'm going to leave it to you to send us out.
All right, thanks. All right. Well, thank you everyone for joining us. And just as a reminder, this was recorded. It will be posted online. It just usually takes us a couple of weeks because we have to caption it before we can post it. This is also part of a monthly series. So we have a monthly webinar on timely tax topics. So keep visiting farmers.gov/taxes to hear what's coming next and stay.
And next is actually bankruptcy next month.
Yes.
So I don't think we have a date for an official title, but it's next month will be bankruptcy.
Yeah. So we try to keep them timely and current. And as new programs roll out, give people information. So kind of knowing that these are challenging times for some producers right now, we're trying to make sure that folks have resources and information and all the tools in your toolbox that might be able to help you or any other farmers you know or are working with. Um, so thank you everyone for joining us and have a great afternoon.